Carnival, I'm the Chuck in the Markets Up Chuck. And today's blog was titled Intel Tells. And, Intel is a, bellwether technology company, and they reported earnings that were down but better than expected and made some noise about some improvements in the, PC business, et cetera. And, one thing about it is I like to put these things into perspective. And Intel actually is a company that I can use to validate a lot of the theses and stories and principles that I talk about quite a bit in this blog. First of all, the first one is earnings determine market price. I want you to notice that Intel had a string of very good earnings from 1991 all the way through 2001, and of course the stock price followed suit. But keep in mind, this included the irrational exuberant period, which shows the importance of valuation, where Intel's stock price got ridiculously overvalued, even though its earnings were good. And of course, eventually the bubble burst, and we know the whole story there, but I do want you to notice that also caused a big drop in Intel's earnings, which made their overly valued stock price very vulnerable. Price fell from 75, all the way down to a low of $14.88. Then had a nice string of earnings here, but over the last several years we've had some inconsistency. But Intel's earnings growth, when it's all said and done at the end of the day, over 20 years has been about 13.5%, and you'll notice that their stock price has correlated to that, or their stock shareholder returns have correlated to that, averaging about 16% versus the market doing 6.5%. But that's over the 20-year period. Let's draw this now as an 8-year chart, because what I really want to emphasize here is the importance of valuation, but also the importance of earnings growth. If you look at the chart going back to 2003, you can see that they were reasonably priced. Their earnings have obviously gotten a lot more cyclical over the last 7 or 8 years. This is really about a 7-year chart here, 6 3/4 years, because I've got 1 year of forecasting in the chart. But I do want you to notice that they did have, nevertheless, some earnings growth. It averaged about 12%. It went from 85 cents up to $1.17 and $1.48. Then it dropped back down to 85 cents, which was a big drop in earnings, and the stock price kind of followed. Then their earnings went up to $1.19. That was a 40% drop. Then another down year, and then another down year, and then expected to be up very strongly going out into 2010, where the current consensus is for about $1.26. This number may end up being a little higher after today's report. But the point I want to make is, if I look at this 6 3/4 year track record, $100,000 in Intel would have grown to $130,000 versus about the same number in the S&P, $122,000. But it slightly outperformed the market. But look what happens if I just chop 1 year off of this chart. Now keep in mind, what I'm going to do is chop this off, this period off here. So if I draw this as a 7-year chart, same company, just 1 year less in terms of time frame with really the same earnings results, but the difference was that Intel stock price starts 2004 massively overpriced. Now if I run the track record on this company, you will see that a $100,000 investment ended up losing 7% a year, and it significantly underperformed the stock market. And the big difference here in this example compared to the last example I showed you was valuation. So it always comes down to earnings and valuation. Getting those two things right can make a big difference, but the principles of sound investing will always apply, and that is, in the long run, the business results will generate shareholder returns, and the market is not always relevant. Obviously, Intel did significantly worse than the market, during this period. If I go back to the 7-year chart, they did almost identical to the market, or just slightly better than the market. But then if I go all the way back to their 20-year chart, their long-term period, then they did significantly better than the market. But it all comes down to a function of what their earnings were and where valuation is at any point in time you're measuring. And this period here, when we were measuring it from this overvaluation, even though we had decent earnings growth during that period, it led to bad results. Now, this is Chuck Carnival. That's my story on the tells that Intel give us and is giving us, and really the tells are that it shows how important fundamental principles of investing really are. It's Chuck Carnival saying thanks for listening. Talk to you again tomorrow.